Ethics in the investment and financial services industries. The investment and financial services industries have a unique position in the economy, providing critical services to both individual and institutional investors. However, with this power and responsibility comes a corresponding ethical obligation to act in the best interest of their clients and customers. Unfortunately, the history of these industries is littered with examples of unethical behavior ranging from insider trading to outright fraud. This module will examine the economic, legal, and ethical implications of fraudulent behavior in financial markets, as well as the moral duties of corporate leaders to investors, shareholders, and customers. In particular, we will explore examples of Wall Street malfeasance, insider trading, the Texas Gulf sulfur case, the Martha Stewart prosecution, and the LIBOR scandal. Wall Street malfeasance is a term used to describe unethical behavior within the financial services industry. This type of behavior can take many forms, including market manipulation, insider trading, and accounting fraud. In recent years, there have been numerous examples of Wall Street malfeasance, including the Enron scandal and the Bernie Madoff Ponzi scheme. It also led to the 2008 financial crisis. The 2008 financial crisis. The 2008 financial crisis was one of the most severe economic downturns in modern history, with significant repercussions for financial markets and the wider economy. The crisis was sparked by a range of factors, including risky lending practices, excessive leverage, and a lack of transparency and oversight in financial markets. In this essay, we will focus on the role of Wall Street malfeasance in the 2008 credit crunch and the impact of the crisis on three major financial institutions: Lehman Brothers, Goldman Sachs, and J.P. Morgan. Wall Street malfeasance refers to unethical behavior by financial institutions and their employees, including fraud, market manipulation, insider trading, and other forms of misconduct. Malfeasance was a major contributing factor to the 2008 financial crisis, with many financial institutions engaging in risky and unsustainable practices that ultimately led to their downfall. Lehman Brothers was one of the most high-profile casualties of the 2008 financial crisis, with the investment bank collapsing under the weight of its own debt. Lehman Brothers had engaged in a range of risky lending practices, including subprime mortgage lending, which left it heavily exposed when the housing market collapsed. The bank's bankruptcy had significant ripple effects throughout the financial system, with many other financial institutions suffering losses as a result of Lehman Brothers' collapse. Goldman Sachs was also heavily impacted by the 2008 financial crisis. Although the bank ultimately weathered the storm better than many of its competitors, Goldman Sachs had engaged in a range of risky practices leading up to the crisis, including the creation of complex financial instruments such as collateralized debt obligations, which were heavily exposed to the subprime mortgage market. The bank was also accused of misleading investors about the quality of its assets, leading to significant legal and reputational damage. J.P. Morgan was another major financial institution that was impacted by the 2008 financial crisis. The bank had invested heavily in complex financial instruments, including credit default swaps, which were also heavily exposed to the subprime mortgage market. While J.P. Morgan ultimately weathered the crisis better than many of its competitors, the bank did suffer significant losses and faced legal and reputational challenges in the aftermath of the crisis. The impact of the 2008 financial crisis was significant, with the global economy suffering a major downturn as a result of the crisis. The crisis also had significant implications for financial regulation, with many policymakers calling for greater oversight and transparency in financial markets in order to prevent similar crises from occurring in the future. In response to the crisis, many financial institutions have taken steps to improve their risk management practices and to avoid engaging in the types of risky lending practices that contributed to the crisis. However, there is still significant concern that malfeasance and other forms of unethical behavior could undermine the integrity of financial markets and lead to further economic downturns in the future. Another famous example of Wall Street malfeasance is the insider trading case involving Raj Rajaratnam, the founder of the hedge fund Galleon Group. Rajaratnam was convicted in 2011 of conspiracy and securities fraud after it was revealed that he had engaged in insider trading on a massive scale. The case was significant not only because of the size of the fraud. Rajaratnam was accused of making over $60 million in illegal profits, but also because of the way in which it highlighted the culture of greed and corruption that exists within some parts of the financial services industry. Insider trading. Insider trading is another form of unethical behavior that has been prevalent in the financial services industry. This type of behavior occurs when individuals use confidential information to make trades in the stock market. It applies when material information that is also non-public information are acted on by an insider, since this information may have an effect on the market value of a corporation's securities. This can give them an unfair advantage over other investors and can lead to significant financial gains at the expense of other investors. One of the most famous examples of insider trading is the case of Martha Stewart. In 2004, Stewart was convicted of insider trading after it was revealed that she had received confidential information about a stock trade from a friend who worked at a brokerage firm. Stewart was sentenced to 5 months in prison, and her reputation as a business leader was irreparably damaged. Other examples. The Texas Gulf sulfur case is another example of unethical behavior in the financial services industry. This case involved a mining company that had discovered a significant deposit of minerals in Canada. Rather than disclose this information to shareholders, the company's executives engaged in a scheme to purchase stock in the company at artificially low prices before eventually disclosing the discovery and reaping significant profits. Essentially, company insiders bought shares of Texas Gulf while knowing about secret drilling activities the public did not know. The case was significant because it demonstrated the lengths to which some corporate leaders will go to enrich themselves at the expense of their shareholders. It also led to a significant legal battle, with the company eventually being forced to pay millions of dollars in fines and compensations to shareholders. The LIBOR scandal is a more recent example of unethical behavior in the financial services industry. The scandal involved the manipulation of the London Interbank Offered Rate, LIBOR, a benchmark interest rate used by banks around the world. Traders at several major banks were found to have colluded to manipulate the rate in order to benefit their own trading positions. The scandal was significant because of the scale of the fraud. The LIBOR rate is used to set interest rates on trillions of dollars in loans and financial products, and because of the way in which it highlighted the culture of corruption that exists within some parts of the financial services industry. Several major banks were fined billions of dollars as a result of the scandal, and there were calls for significant reforms to the industry in order to prevent similar abuses in the future. Similarly, when officers at Wells Fargo were caught defrauding investors, its president, John Stumpf, claimed that the fraudulent accounts were the fault of individual employees and their managers gone rogue, and not that the sales problems were not indicative of deeper cultural flaws. In this way, he minimized his moral duty and responsibility as a corporate leader. In fact, it is the responsibility of a corporation to infuse a culture of compliance and not corruption within a company.